Welcome to another deep dive. Today we are tackling a massive topic, the buy, hold, and sell blueprint, equity, mutual funds, REITs, and gold ETFs. And we're specifically zooming in on part 6, which is exactly when to buy and hold REITs. Listen, if you want to allocate capital like a true institutional player, you've got to strip away the emotion and look strictly at the math.
Welcome viewers to Bodhi Unified Flow. Here we simplify complexity and amplify performance. We are about to decode some seriously complex institutional strategies and translate them into a completely actionable framework just for you, the retail investor. We're leaving all the generic fluff behind today and focusing on the pure, quantitative metrics that actually drive returns in the real estate markets.
All right, here is our quick agenda for today's explainer. 1. Decoding REIT valuations. 2. When to buy REITs. 3. When to hold REITs. And finally, 4, we'll wrap it up with our summary and references.
Okay, let's dive right into this. By the end of this explainer, you are going to absolutely master the real metrics of real estate. Things like FFO, AFFO, and NAV. You'll be able to pinpoint the exact macroeconomic shifts and the hard data points that trigger a buy. You're going to understand how to evaluate tenancy risk using a really cool metric called WALE. And crucially, you'll know exactly how to measure a REIT's debt shielding so you can define your strict hold conditions.
Let's kick things off with Section 1, Decoding REIT Valuations, the language of commercial real estate.
So to trade real estate like an institution, we have to completely abandon traditional equity metrics. If you try to analyze a REIT using standard price-to-earnings ratios, you're literally setting yourself up for failure. The math just won't work. Here's why. Think of accounting rules like a really strict parent, forcing you to write down the value of your property every single year, claiming it's getting older and less valuable. That's depreciation. But in the real world, commercial real estate typically appreciates over the long run, right? So this massive on-paper depreciation artificially drags down the net income. It completely hides the actual cash-generating power of those buildings.
Because of that, we use something called funds from operations, or FFO. We take that flawed net income number, add back those massive depreciation charges, and strip out any one-time gains or losses from selling properties. What does this do? It reveals the true economic earnings. We can even take it a step further with adjusted FFO, which subtracts routine maintenance costs, things like fixing a leaky roof. This right here is the ultimate metric to see if a dividend is actually safe and covered by real cash flow.
And that cash flow, that builds the foundation for our next core metric, which is net asset value, or NAV. Guys, NAV is the absolute bedrock of REIT valuation. It is the marked-to-market value of all the physical properties owned minus the total liabilities. Unlike your standard book value, NAV tells you the actual real-world private market value of the underlying real estate today.
So once we understand the underlying value, we really need to understand the risk and the revenue visibility. And for that, we look at WALE. That stands for Weighted Average Lease Expiry. Basically, it's the average remaining contractual lease duration across the entire portfolio, and it's weighted by how much rental income each space brings in. Think of WALE as your absolute ultimate indicator of tenancy risk.
Now, what's really fascinating here is the dynamic between a short and a long WALE. A short WALE, meaning an average lease expiry under 4 years, well, that naturally carries higher turnover risk, right? Tenants can leave. But in a booming economy where market rents are just skyrocketing, it's actually a massive growth lever. It lets the REITs rapidly reset their rents to those new, higher market rates. On the flip side, a long WALE of over 5 years acts as this incredibly powerful anchor. It gives you stable, contractually secured cash flow that is highly attractive to risk-averse buyers who just want absolute safety.
Before we move into the actual buying triggers, we have to talk about this geographical yield disparity. To put this into perspective, mature markets like the US are currently seeing average REIT yields sitting in the 2% to 3% range. But listed Indian REITs, they average a much higher 5 to 6% yield. And here's a really fun fact for you. A lot of those higher Indian yields are actually backed by the exact same multinational tech giants you'd find in the US, but they're occupying premium grade A Indian office space. It's a massive structural advantage, and it is absolutely worth paying attention to.
All right, moving on to Section 2, When to buy REIT, Quantitative and Macro Triggers.
So this is where we transition from the theory to the actual execution with our BY matrix. First up, you want to look for a price-to-NAV ratio below 1.0. This literally means you are buying properties at a discount to their private market value. That creates an immediate margin of safety. Second, you want same-store net operating income growing at over 5%, which proves there's robust organic growth. Third, an occupancy rate above 90%. This proves there's strong demand and a really tight market supply. And finally, you want a loan-to-value ratio below 30%. That gives the REIT massive headroom to acquire even more properties without having to dilute your shares.
But here's the thing. Fundamentals alone aren't always enough. You really want the macroeconomic wind at your back. The ultimate macro buy signal for a REIT, that's a central bank easing cycle, specifically interest rate cuts. When the Fed or the RBI starts cutting rates, borrowing costs plummet. That makes debt-funded acquisitions highly profitable. It also compresses cap rates, which aggressively drives up property valuations. And as government bond yields drop, the high dividend yields of REITs suddenly look incredibly attractive to income investors. To give you some context on how powerful this is, historically, in the 12 months following a rate cut, U.S. REITs have delivered over 9% annualized returns.
Okay, I need to give you a massive warning on your buy criteria right here. Absolutely do not chase yield blindly. Different property sectors have entirely different risk profiles. For example, data centers might only yield 2% to 3%, but they offer massive capital appreciation driven by AI and cloud demand. Retail net leases sit really comfortably around 5%, usually backed by necessity anchors like big grocery stores. But then you look at mortgage REITs, or M-REITs, sitting at 10% to 14%. Keep in mind, they don't own physical property, they own debt. They are hypersensitive to interest rates, and that massive double-digit yield, it frequently leads to brutal capital erosion over time. So don't be fooled by the big number. You have to know what you're actually buying.
Let's shift gears to Section 3, when to hold REITs, preserving the yield. Because doing nothing often requires just as much discipline as executing a trade.
So why do we hold REITs? It's really because of this one specific number, 90%. By strict regulatory mandate, whether we're talking about SEBI in India or the IRS in the US, a REIT must distribute at least 90% of its net distributable cash flows right back to you, the unit holder, typically as quarterly or semi-annual dividends. This unique structural mandate is exactly why REITs are such incredibly powerful income anchors in any portfolio.
But, and this is a big but, you only hold if the underlying operational buffers are totally intact. You hold when the REIT is trading at a fair public market price, meaning it's hovering right around its intrinsic NAV. You hold when that WALE metric we talked about remains above 5 years, giving you high income stability. And you hold when the management team proves they can execute effective capital recycling. That basically means they're actively selling off their older, low-yielding assets and using that cash to develop brand new, high-yielding properties without having to load up on dangerous debt.
And this brings us to our final and arguably most crucial check, debt shielding. Look, real estate is capital intensive, so having debt is just inevitable. But you only hold a REIT through a full market cycle if its balance sheet can withstand a sudden spike in interest rates. We want to see over 60% of their total borrowings locked into fixed interest rates. We want an average debt maturity profile of more than 4 years, so they aren't suddenly forced to refinance right in the middle of a credit crunch. And we absolutely demand an interest coverage ratio greater than 4.0x. That proves they're generating more than enough cash flow to effortlessly cover their finance charges. If these metrics hold, you hold. It's that simple.
All right, let's wrap this all up in Section 4, Summary and References.
We've covered a ton of ground today. We successfully tossed out that flawed PE ratio and replaced it with the true institutional standards of FFO, AFFO, and NAV. We established a strict, totally emotionless buy matrix that demands a price-to-NAV discount and an LTV under 30%. We mapped out exactly how WALE dictates your tenancy risk and portfolio stability. And finally, we defined what structural buffers, particularly debt shielding, are absolutely required to justify holding a REIT for the long term. You now have a highly systematic framework to approach commercial real estate allocation with total confidence.
Just really quickly, the strategies we've outlined today are rigorously grounded in top-tier financial documentation. We source these quantitative thresholds directly from the Buy, Hold, and Sell Blueprint, the regulatory guidelines from SEBI and the US IRS, institutional insights straight from Morgan Stanley, and fundamental breakdowns from the Zerota Varsity Educational modules.
Which brings us to our final thought for the day. The rules are crystal clear. The math is right in front of you. When the next market correction inevitably hits, causing asset prices to swing wildly all over the place, are you going to react with panic and emotion, or will you trust the data, analyze those NAV discounts, check the debt shielding, and execute the blueprint? Thank you so much for watching, and we will see you in the next explainer.